Imagine this. You're at a cricket match. The batter hits 6 after 6. The crowd roars. The commentators can't stop praising him. And you think, this guy is unstoppable. He'll keep hitting sixes forever. Now imagine you are an investor. A stock has gone up 50% in the last year. Everyone is talking about it. Your friends are making money. The media is celebrating it. And you think, this stock is unstoppable. It'll keep going up forever. That, my friend, is recency bias. And it is one of the most dangerous forces in investing. So what exactly is recency bias? In simple terms, it's our brain's tendency to give more importance to what happened recently than what happened in the past. We assume that whatever just happened will keep happening. If the market went up yesterday, we think it'll go up tomorrow. If a stock fell last week, we think it'll keep falling. Here's a simple analogy. Think of a book. If you only read the last chapter, would you understand the whole story? Of course not. Yet that's exactly what recency bias does. It makes the most recent chapter your entire investment thesis. Recency bias isn't just a quirk. It's rooted in how our brains are wired. First, our brains are designed to remember what happened recently. It's an evolutionary survival mechanism. If a tiger attacked your village yesterday, you needed to remember that today. Second, there's something called the availability heuristic. This is where your brain judges how likely something is based on how easily examples come to mind. If you've recently seen headlines about a stock market crash, those examples are fresh in your mind. So your brain thinks, crashes must be likely. If you've seen headlines about record highs, your brain thinks, more records must be coming. Third, humans naturally extrapolate trends. If something has been going up, we assume it will continue going up. If it's been going down, we assume it will continue going down. It's simple, it's intuitive, and it's often wrong. Fourth, there's loss aversion. This is the psychological fact that losses hurt about twice as much as gains feel good. Losing 10,000 rupees feels more painful than gaining 10,000 rupees feels satisfying. Now here's the dangerous part. When you combine recency bias with loss aversion, you get a recipe for disaster. Because when markets fall, recency bias makes you believe they'll keep falling. And loss aversion makes the pain so unbearable that you just want to escape. Here's how this plays out in real life. Watch this cycle carefully. Market falls. You check your portfolio. Portfolio is red. You consume negative news. Negative news reinforces your fear. You assume the future will resemble the recent past. You exit. Then what happens? Market eventually recovers. But you're sitting on the sidelines. You wait for confirmation that the recovery is real. You re-enter after prices have risen. Congratulations. You just sold low and bought high. Without ever consciously intending to. This is how recency bias and loss aversion work together to destroy wealth. Let me show you what I mean with real stocks. Real data. Real money. Take TCS. In August 2004, TCS listed at 850 rupees per share. Over the next 2 decades, the company issued bonus shares 3 times, in 2006, 2009, and 2018. Today, each original share has become 4 shares. And the stock now trades around 4,500 rupees, delivering approximately 50 times returns in 20 years. But here's the critical part, it didn't go up in a straight line. Look at 2013, TCS returned a stunning 71%. Then 2014, 17%, but 2015, minus 4.5%. 2016, minus 2.9%. Investors who bought in 2015 waited nearly 2 years just to break even. Then came the pandemic, TCS crashed to 1,504 rupees in March 2020. And recently, TCS delivered 8% in 2024, then minus 20.85% in 2025, and is down another minus 22.8% in 2026 so far. Your brain sees the recent losses and thinks, TCS is finished. But zoom out. The same stock that crashed to 1,500 rupees in 2020 soared to 4,585 rupees by December 2024. The investor who sold in panic missed the recovery. The investor who held, through every deep, every flat period, every doubt, is now sitting on a fortune. Now look at Asian Paints. The stock's all-time low was 20 rupees and 67 paise in March 2003. At its all-time high of 3,590 rupees in September 2022, that represents a staggering 173 times increase from its low. A small investment would have become a fortune. But here's the warning. Today, Asian Paints trades around 2,700 rupees to 2,750. That's down nearly 25% from its all-time high of 3,590 rupees in 2022. The stock that was yesterday's winner became today's disappointment. Your brain looks at 3,590 rupees and then 2,700 rupees and thinks, Asian Paints is broken. But is it? Or is it just in a flat phase of its cycle? The investor who bought at the peak in 2022 has been waiting for 3 years. The investor who bought at 20 rupees in 2003 is still sitting on a 130-fold return. Stocks work in cycles. They jump, then stay flat or negative for some time, before bouncing again. And then there's ITC. The stock's all-time low was 10 rupees and 70 paise in February 2003. In September 2024, ITC hit an all-time high of 528 rupees and 50 paise. That's a 49 times increase from its low, a phenomenal return. But look at the recent numbers. ITC returned just 3.55% in 2024. And after peaking at 528 rupees and 50 paise in September 2024, the stock has fallen dramatically, to around 273 rupees to 287 rupees in August 2026. That's a decline of nearly 50% from its peak in just 2 years. Investors who bought ITC at its peak in late 2024 have watched their investment cut in half. The stock that was once everyone's darling became everyone's frustration. Your brain sees 528 rupees, then 273 rupees, and screams, sell. But here's the thing, ITC went through similar cycles before. In 2008, it fell -34%. In 2009, it rose 52%. The cycle repeated. The investor who sold in panic in 2008 missed the recovery in 2009. It's not just stocks. Mutual funds suffer from the same phenomenon. Take Parag Parikh Flexi Cap fund. Over 10 years, the direct plan delivered a CAGR of 17.97% compared to the category average. A 10,000 rupees monthly SIP grew to nearly 33 lakh rupees. Spectacular performance. But look at the recent numbers. For the 1-year period ended June 2026, Parag Parikh delivered -1.94%. Meanwhile, HDFC Flexi Cap Fund delivered +0.86% in the same period. Quant Flexi Cap Fund has delivered a 10-year CAGR of 21.02%, significantly outperforming Parag Parikh's 17.97% over the long term. And over the last 1 year, Helios Flexi Cap Fund delivered 7.09%. Suddenly, investors are questioning, is Parag Parikh still good? Should I sell? This is recency bias in action. But here's the catch. HDFC Flexi Cap, which is outperforming now, has a 10-year CAGR of just 16.64%, lower than Parag Parikh's 17.97%. The fund that's hot today was cold yesterday. The fund that was cold yesterday may be hot again tomorrow. Now let's zoom out even further. Compare the Indian stock market to the US market over 20 years. Between February 2006 and February 2026, the Nifty 50 rose from roughly 2,835 to about 24,825 points, a total growth exceeding 775%, delivering approximately 11.6% CAGR. Meanwhile, the S&P 500 returned approximately 503.7% between August 2006 and August 2026, a CAGR of about 8.8%. Over 2 decades, India outperformed the US. But here's the catch. Look at the recent 2 years. The S&P 500 delivered approximately 25% in 2024 and approximately 14 to 18% in 2025. The Nifty 50, around 8.8% in 2024 and 10.5% in 2025. The US has outperformed recently. So investors are piling into US funds. But what if the cycle turns? What if India outperforms in the next decade? If you look at the last 20 years, India wins. If you look at the last 2 years, the US wins. Which one is the right answer? It depends entirely on your time horizon. Here's the truth. Recency bias works in both directions. Bearish recency bias, after a crash, you assume more pain is coming. You sell at the bottom. Bullish recency bias, after a rally, you assume more gains are coming. You buy at the top. Sector recency bias, you chase whatever sector just performed best. Tech, pharma, banking, whatever was hot yesterday. Asset class recency bias, you pour money into whatever asset class just shined. Equities, gold, silver, real estate. Fund manager recency bias, you chase the fund manager who just had a great year. Market level recency bias, you favor whichever country's market just outperformed. Every single one of these biases can destroy your returns. Here's another pattern you need to understand. In most cases, the narrative follows the price movement. Cycle starts. Price rises. Investors notice. Media explains why. A narrative develops. More investors buy. Price rises further. Then one day, price falls. Investors panic. Media explains why. A new negative narrative develops. More investors sell. The narrative changes after the price changes. Not before. The media doesn't predict the future, they explain the past. And they explain it in a way that makes recent performance seem inevitable. Don't mistake a story for a strategy. So how do you fight this? How do you protect yourself from your own brain? Start by asking yourself 5 simple questions before you change an investment because of recent performance. 1. What has changed in the business? 2. What has changed in the valuation? 3. What has changed in the investment thesis? 4. Am I reacting to fundamentals, or just to price? 5. Would I make the same decision if I couldn't see the last 12 months' return? If you can't answer these questions honestly, you're not investing. You are reacting. Here's a decision hierarchy that will save you from yourself. Number 1. Investment objective. Why are you investing? What are you trying to achieve? Number 2. Time horizon. When do you need this money? Number 3. Asset allocation. What mix of assets makes sense for your goals? Number 4. Fundamental or business thesis. Does the business still make sense? Number 5. Valuation. Is the price reasonable? And number 6. Recent performance. Notice where recent performance sits. It's last. It's an input, not the deciding factor. Most investors do the opposite. They start with recent performance and work backwards. That's a recipe for disaster. Use multiple time horizons to fight recency bias. Don't just look at the last 1 year. Look at 3 years, 5 years, 10 years. And don't just look at point-to-point returns, look at rolling returns. What are rolling returns? Instead of measuring performance from one fixed start date to one fixed end date, rolling returns measure performance over multiple overlapping periods. For example, instead of just looking at 10-year returns from 2015 to 2025, you look at 10-year returns from 2014 to 2024, 2013 to 2023, and so on. This gives you a much better picture of consistency. It eliminates the bias of a single start date or end date. It shows you how the fund or stock performs in different market conditions. It's a powerful tool against recency bias. Here's a psychological framework that can help. Think of yourself as having 2 voices. One voice is emotional. It's scared of losses. It wants to follow the crowd. It believes whatever just happened will keep happening. The other voice is rational. It knows that markets are cyclical. It knows that short-term noise doesn't change long-term fundamentals. It knows that your time horizon matters more than today's headlines. Your job is to listen to the rational voice. Not to silence the emotional voice, that's impossible, but to recognize it for what it is. Fear and greed are feelings, not facts. Now let me give you a checklist. Here is the simple checklist to avoid recency bias. Before selling, ask, is this based on a change in the business or a change in the price? Have I held this investment for at least one full market cycle? Am I selling because of fear or because of facts? What would I tell a friend in the same situation? And before buying, ask, is this based on genuine opportunity or recent hype? Does this fit my long-term asset allocation? Am I buying because of FOMO or because of fundamentals? What would I tell a friend in the same situation? Remember, investors don't usually lose money because they don't know enough about the market. They lose because they allow their emotions to change their time horizon. Let me leave you with a new way of thinking. Don't ask, what has performed best recently? Instead ask, what is likely to help me achieve my financial goal over my investment horizon? And don't ask, is this fund or stock good or bad? Instead ask, what explains its recent performance, and has that changed its long-term thesis? These are different questions. They lead to different answers. They lead to better decisions. Because here's the truth, the market doesn't care what happened yesterday. The market doesn't care about your emotions. The market doesn't care about the headlines. The market only cares about one thing, the long-term value created by businesses. So here's my question to you. Have you planned your financial future? Not just for the next year. Not just for the next market cycle. But for the life you want to live? If you haven't, there's no better time than now. Because the markets will always have winners and losers. The headlines will always scream. The narratives will always shift. But your financial goals don't change with the market. Your life goals don't change with the market. And your investment strategy shouldn't either. Don't let the most recent chapter become your entire investment thesis. Remember the cricket match we started with? The batter who hit all those sixes? He eventually got out. Every batter does. That's the nature of the game. Stocks are the same. Every stock has its day. And every stock has its night. The question isn't whether a stock will go up or down. The question is whether you have the patience and the discipline to stay invested through both. Recency bias will tell you to chase what's hot. It will tell you to run from what's cold. But the real money, the life-changing money, is made by those who see beyond the last chapter. Don't let recency bias write your financial story. You are the author, not the market, not the headlines, not your emotions. I took early retirement after 23 years in technology and architecture. Not because I was lucky, but because I understood that investing is not about predicting the future. It's about preparing for it. It's about understanding your own mind. It's about building systems that protect you from your own emotions. It's about having the patience to let compounding work its magic. You can do this too. Start today. Plan your financial future. And remember, the most dangerous words in investing are, "This time is different."